Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin. Craig is a certified financial planner. He's one of the principals for the Family Wealth Consulting Group. They are fee-only financial planners. They provide asset management services. He's been doing it for over 35 years, only yesterday.
A long time, Mike.
Dear. He's the author of a book, Craig Martin on Asset Class Investing, and I'll bet if you asked him, he would be glad to send you a copy. Peggy would like to get it out of the closet. Anyway, I've known Craig for a number of years. I've learned quite about investing from Craig, and so I invited him here today to share some of his wisdom with us. So we're going to talk about asset class investing.
An appropriate topic.
Craig, thanks for joining me today. It's great having you here today.
Thank you, Mike. It's great to be here. You are recording some of the best people in the financial industry from our community here in the Bay Area on these shows. And I just don't know anybody else that's doing what you're doing. So I commend you for it, and I'm proud to be here.
Great.
I think that's great.
Thank you for that.
Yes.
All right, Craig. Well, gee whiz. We've just been through interesting times. The old Chinese proverb, right? May you live in interesting times. We've been living through them. And since 2000, we've been through a couple of very severe financial adjustments, if you will. And so a lot of people, frankly, have been afraid to invest in the stock market at all. As I understand, there's quite a bit of cash still sitting on the sidelines.
Yes.
Should I be sitting on the sidelines?
No.
No?
No.
Oh, okay. Tell me about it.
So if we knew when the markets were going to go up or down, we'd, of course, time the market appropriately, but we don't know. We just don't know. So a key investment methodology that I'm going to be promoting today is what we call buy and hold.
Okay.
If we look at slide number 1, it shows that for a 42-year time frame ending December of 2012, the returns of $1,000 in the blue dark black bar on the far left were 9.9% per year, resulting in $56,769 for every 1,000 that we started with. And that's over most of your listeners' investment time horizon.
Yeah.
The way that was earned is by buying every stock in the stock market, all of them, and holding them forever. It turns out that is very difficult to do, and many investors go in and out of the market. But in this example, in this chart, if the investor had chosen to get out of the market one day each year, and that one day was the very best returning day for that year, the return for that investor would have been reduced from $56,700 to $52,700. That's a significant loss of money per $1,000 invested. The real indictment is if you'd chosen to do that for 5 days each calendar year, and it turned out that those 5 days were the best returning 5 days of the calendar year, your return would have dropped significantly from $56,700 to $38,000 plus. That's a devastating loss of principal simply for the fear of what might happen on that one day of trading. In other words, overcome your fears, buy the whole market, and hold on for a lifetime.
Okay.
The only way to get the returns of the stock market is to buy and hold.
Okay. Should you disregard your emotions when making investment decisions? What is the role of your emotions in this process?
Oh, your emotions are huge. There was a Nobel Prize issued to Professor Kahneman in 2004 for what is called behavioral finance. Behavioral finance could be described as how we think about money. Besides money, there's a whole range of emotions that we suffer enjoy as human beings, but around money, it's devastating in how we make choices. An example of that is on slide number 2. In slide number 2, we're going to look at the returns of the S&P 500 index. Again, that's the 500 large cap stocks of America. And for the 20-year period ending 2011, if you'd purchased that S&P 500 20 years ago and held it forever, every day, never traded out of it, you'd have earned 7.8%.
Okay.
However, studies in the marketplace show that the average investor doesn't buy and hold. In fact, the average investor will buy and sell, buy high and sell low consistently, such that the average investor in the marketplace is earning half or less, look at the left bar on that chart, half or less of a simple buy and hold of the marketplace. Your emotions are dominating that. Strictly emotions that's causing that. By the way, the slide is titled "Fear and Greed."
Right, right. So, of course, that's what drives many investment decisions.
Oh,
and
a
unfortunately,
huge number.
It moves us to do exactly the wrong thing.
Yes.
Okay.
Yes.
Well, gee whiz, I mean, 3.49 compared to 7. Well, gee, I'm probably going to make these wrong decisions and so forth. Maybe I shouldn't even be in the stock market. Should the average person even invest in the stock market?
Yes, it's the equity investing is the only way to beat inflation after taxes and expenses. Otherwise, banks, bonds, and bills will ultimately lose buying power because you're paying taxes and expenses and suffering inflation. Equity is the only way we know to beat that over a long period of time. Take a look at the slide number 3. This is a exceptionally long period of time, 87-year track record in the stock market. What it shows is the returns of stocks, bonds, bills, and inflation, and the return of $1 invested into all 4 of those investment categories. So on the left-hand side of the horizontal line is the year 1926. On the right side is the end of the year 2011. That is an 87-year time frame.
Yeah, real long.
And the chart shows the foundation or table upon which all investments sit, which is inflation. It is the gray mountain table on that chart at the bottom. The next line up is Treasury bills, and we see that inflation earned you would need $13 today to have the same buying power $1 had in 1926, and that's at a 3.0 inflation rate per year. That's the average inflation over that time frame.
Hard to believe. You'd think it would be more than that, but anyway, go ahead.
Yeah. In the 80s, remember, it was double digit.
Right.
So Treasury bills earned $21 during that time frame relative to the 13 that inflation would need. Corporate bonds earned $119 at 5 less than 6% per year. However, equities, all the stocks in America from 1926 through the end of 11 is the blue line. The light blue line shows that $3,048 would have been earned by every dollar in your investment portfolio if you had purchased every stock in America and held it. So grandfather would have had to start that portfolio and purchased every stock in America and held it through his lifetime, through your parents' lifetime, so that now you hold that same portfolio. And it would have averaged 10%, 9.8% per year during that time frame. I round that off at 10%. So what I say is that the stock market over your lifetime has earned about 10%. We would expect it to earn about 10% over the rest of your lifetime. And the only way to get that is to buy and hold it. Most important is the next chart, slide number 4. In slide number 4, we see that the growth of $1 in the U.S. stock market over the last 20 years would have averaged 8%, 8.11% per year. But notice the huge peaks and valleys twice in the last 20 years. Mike, you started with that conversation earlier. And we've had 2 recessions from 2000 to 2008, which approached or exceeded a 50% downturn in the market values. However, it has totally recovered since then, and the average return was 8.11%. So what I like about this chart is that average return line, straight line in the middle of the chart, which says if you'd purchased and held that stock market during that 20-year time frame, you'd have earned an average of 8.11%. Now, you may not have been able to sleep some nights, but in the end, you would have earned 8.11%, which is a reasonable return.
So it's been an interesting period, like we said, and we are to a point of, we've been telling people over the years, you're going to be on that roller coaster. You're going to have those white knuckles. But then, eventually the roller coaster is going to be coming back up to that level again. And so for the people who were able to stick it out, it worked out. Now, one thing, you mentioned the thing about, the portfolio, and so the S&P 500 obviously wasn't the same in 1926 as it is today. There are companies that have gone away, and there are companies that come in. So basically, we were talking about that whatever made up the S&P 500, if we had an index fund over that whole time, that's more or less what we would be doing.
Yes, good observation, Mike. We can buy the S&P 500 by buying all 500 stocks ourselves, or we can buy a mutual fund called a mutual fund that replicates the index. We typically call that an index fund. That index fund buys them for us. Each year, that list of 500 stocks is changed by the company called Standard & Poor, and the index fund replicates the actual computer model index inside their mutual fund by buying and by selling those that have been taken off the list and adding those that have been put on. That's about 16% of the total portfolio every year is changed. 16%.
They've actually, I guess, been talking about adding Facebook to the S&P 500.
Really? So. That's good.
Okay. So, I think a really big factor in this whole thing is time. And so I wanted to focus on that for a few minutes. I mean, you for example, were referring to the period from 1926 to 2012 and so forth.
Long time frame.
So what is the role of the time horizon in this whole investment process?
Significant, Mike. The longer you hold an equity portfolio, the lower its risk becomes to you on a buy and hold scenario. So in slide number 5, this has got 2 different charts on the same slide. It shows the equity market returns over 1-year and 10-year, rolling 10-year time frames. So let's start with the top chart. What it shows is the colored bars on top of the horizontal line demonstrating positive returns per year on a 1-year basis from 1926 through to 2012. And the negative years are below the line. And if you notice, it concentrates during the Depression, 1929 through 34, 33, with some negative years in the current several decades.
Like 2008?
Like 2008, yes. If we take the statistical average, what it says is that 1/4 of the time, 28% of the time, on an annual basis, you're going to lose value in your stock portfolio. 72% of the time, you're going to have increasing value in your portfolio of some degree. Most importantly is the bottom chart, because that's a rolling 10-year average starting in 1926. And the way we calculate that is to add the newest year and subtract the oldest year and take the average of all those rolling 10-year periods. And what we see is that the positive returns, again, are above the line. The colored bars above the line. The negative years are below the line. As in the top chart, the negative years are concentrated during the Depression, a small number of negative years in the past seven decades, literally. So the chances of you having a negative return in your equity portfolio over a 10-year period are less than 5%. That is significant. Means every 10 years you can expect to have a positive return in your portfolio.
So basically what it's saying in the bottom chart is 95% of the time it was in the plus territory.
Yes.
On a rolling 10-year investment horizon.
Yes.
So anyway, I guess what, again, I want to point out is time is critical. Time in is critical for this whole process.
Yeah, we started out talking about emotions. Should we be in the stock market? And my answer was absolutely yes. But how much do emotions control our investment decisions? Significantly. The way to overcome those emotions is to build a discipline. Part of that discipline is to buy and hold. And this example, this chart demonstrates that all you have to do is hold it 10 years and you have a 95% chance of having a positive return in your portfolio.
Okay. Now, there's an awful lot of talk, when people are talking about the stock market. So one, of course, is they're talking about the hot stock.
Yep.
And they're talking about timing the market. You know, what's the right time to get in? What's the right time to get out? So, what do you have to say to this stuff?
Don't do it.
Oh, okay. Well, maybe you can explain a little bit to us about why and so.
So when I give public presentations, I open the presentation by asking the audience, who knows the future? Who do you know that knows absolutely the future? And nobody says anything. And
well, Harry Dent says he knows.
Harry Dent tries to prove to us that he does, and is wrong more times than he's right, which means he's merely guessing. And that's the issue around the bobbing heads on TVs. You're listening to people give their opinions of what they think is going to happen in the future. The truth is that if we really knew what was going to happen in the future, we wouldn't be on TV talking about it. We'd be leveraging every dollar we could get a hold of because we knew tomorrow's prices. So since nobody knows the future, nobody can study the past and pick stocks and time the trades and outperform a simple buy and hold of the marketplace over our lifetime. Since nobody can do that, the solution is to just buy and hold. Let's take a look at slide number 6. Slide number 6 shows the results of people who are hired to study the past, active mutual fund managers or stock pickers. They're hired in mutual funds to study the past so that they know which stock to buy and when to trade it, because by studying the past, they think they know the future prices. Over a 5-year period ending in 2012, the far left bar says that 75% of the people trading large cap stocks, that would be the people trading stocks, for instance, that are found in the S&P 500 index, the large cap, the largest companies in America. 75% of those people trying to pick the stocks and time the trades underperformed the index, the S&P 500 index. We're back to this buy and hold story. And if I knew today who the top quartile was going to be of performers was going to be 5 years from now, we of course would invest in them today and hold them for 5 years, and I'd end up in that top quartile, but I don't know who they are. And I don't know anybody else that knows how to pick them. The next bar shows the mid-cap stocks, slightly smaller stocks than the largest in America. 90% of the people trying to pick stocks and time the trades underperform an index of buying all the stocks in that asset class. The small cap stocks, 82% of the managers are underperforming.
So all these guys that are going on what used to be Wall Street Week or whatever it is today, and they're talking about what the stock market's going to do tomorrow.
Pure guess.
Okay.
In fact, statistically, we're able to show that I can flip a coin or line up a bunch of monkeys to throw darts and outperform stock pickers. Statistically, they are not performing up to average of statistics.
You know, we're paying these guys all this money.
Yes, lots of money.
Okay.
Lots of money. Recent study put out by the University of Chicago that calculates that number to be quite large. I've forgotten what it is, but it's in excess of $1 billion a year.
Wow.
Paid in commissions and research costs for people who say they can study the past and know the future.
So maybe you can tell us a little bit about what's going on as far as how people are responding to this. Are they doing more active investing?
Yeah, interestingly enough, Mike, we met a long time ago, and about the time we met, I looked at the academic research in the marketplace, and I said, I'm going to get out of trying to pick stocks and time the trades or find mutual fund managers that do. And I switched over to what we call passive investment. That's buying the whole marketplace and holding on. At the time we did that 25 years ago almost, we guesstimated that less than 2% of the marketplace was engaged in that activity. In other words, 98% of the marketplace was engaged in what I call mythological behavior, trying to pick stocks by studying the past so that they could know the future prices. 10 years ago, studies showed that on slide number 7, slide number 7 shows that 10 years ago, 13% of the marketplace was engaged in passive management of their equity stock portfolio. Most of that, by the way, was in the institutional marketplace, the pension plans, foundations, endowments. Today, it approaches 30%. That is a geometrically growing percentage in a growing marketplace. In other words, the marketplace today is about twice as big as it was in 2000, and 3 times, 2.5 times the number of people trading passively are now doing it that way in the marketplace. It tells me that 10 years from today, that number could be much larger, 40-50%. Wall Street is no longer the dominant player in the stock market. The passive investors are beginning to dominate how the market is moving going forward.
You know, and meanwhile, I mean, there are countervailing forces, and I guess what I'm getting at is the headlines.
Yes.
And so we've got the headlines on the Wall Street Journal. We've got, the financial magazines, Money Magazine, and so forth. You know, what are the 10 hot stocks for this year, and so forth. So, what about all of this stuff that's coming as far as, in the media and so on?
It turns out that the public is greatly influenced by fear. We talked about that earlier. And it is the job of the public press to generate emotions in their viewers. And the easiest emotion to generate is fear. Fear of the unknown, fear of the future. So it is common for the public to watch the press and not trade passively, but to time the market by getting out as the market goes down or hits its valley of returns, such that in 2000 through 2002, the market went down 48% in that time frame, and more money left the market, the equity market, in that time frame than had ever left the market in the past. In other words, by the time the market had reached its valley and started back up, people were taking their money out and putting it in cash. As the market approached its peak, more money went in. Much of this money went back in.
Sell low, buy high.
They were selling low and buying high. Previous slide we talked about showed that the average investor is getting half the return of a buy and hold of the marketplace simply because of their emotions. So yes, the countervailing forces to a trend to passive investing in the marketplace is that the public continues to be dominated by public press. Public press's job is to generate emotions. The easiest emotion to generate is fear. And in the stock market, it's real easy to generate fear.
Okay, we just have a couple minutes left, but I think I just want to cap that last comment before we go to our final thing, and that is, you don't sell newspapers, you don't sell magazines by saying, just buy and hold and sit on your investment. I mean, so where's the interesting story there?
Yeah,
right?
Pretty boring. The second time you say that, it becomes pretty boring.
Okay. So what is the role of the professional advisor in all of this process? Why use a fee-only financial planner?
Yeah, thanks. So fee-only means that we work for the client. We don't work for the big corporation. Fee-only means that I've given up my license to receive a commission for the sale of a security. We're about advice and counsel. The designation and degrees that I have a Master of Science of Financial Services, which is a master's level work in estate tax planning, income tax planning, investments, and cash flow. And we bring people, experts like you, into our team, the CPA, tax preparer, so that we can get the best advice and counsel as a team effort for our clients' benefit. And our goal is to help that client make informed decisions. So on slide number...
Okay, we really are out of time for slides, Craig. So the idea is, though, that we can be in a team process working together, and you're doing it on a fee basis rather than being paid with a commission, so you can be on the same side as the client.
Thank you, yes.
Okay. Folks, we are out of time. Thank you so much for joining us today. I hope that we've given you some good information to think about, and we'll see you next time on Financial Insider Weekly.